Welcome to this April edition of our regular All Things Superannuation vlog. We are all now awaiting with bated breath to see what will be included in this year's federal budget that will impact on the superannuation environment in particular, and in the wider financial and economic areas which impact our work for clients. We hold out some hope that the government will make some announcements with respect to the outstanding superannuation issues to be legislated, and in particular to provide some clarity around certain changes. I don't propose to discuss any issues associated with advice regulatory matters in this blog, but rather concentrate on some superannuation issues that have recently been the subject of media discussion. As we're all aware, the government has announced contentious measures to increase the level of taxation for a member whose total superannuation balance exceeds $3 million, referred to as the Div 296 tax. There have been many discussions about the taxation under these measures, but of course the issue of major concern is the taxation of unrealised capital gains, which would be virtually unprecedented in this country. Whilst the proposed methodology for calculating the level of tax is relatively straightforward and relies on the records that the ATO would currently hold for the majority of superannuation members, a vexed issue is the calculation of defined benefits for the purposes of this tax. If we consider the changes implemented in 2017 to value defined benefit pensions, the methodology was relatively simple. Quite simply, a calculation of 16 times an annualised benefit. However, this was a very blunt tool to calculate values and, to my mind, significantly acted to the detriment of older members in receipt of defined benefit pensions. The proposed methodology for the Div 296 tax is to utilise calculations that would apply when valuing defined benefit superannuation interests for family law purposes. These calculations of the value of the accrued benefit are made at the operative time using assumptions and methods specified or approved by the Australian Government Actuary. This involves the calculation of the discounted present value of the member's likely superannuation benefits, and which takes into account the specified probabilities of leaving service due to retirement, resignation, invalidity or death, using the specified factors to obtain value benefits. For anyone who's provided advice on, say, CSS or PSS federal government benefits would also be aware that there's a specific Act of Parliament in which can be found the formula for calculating benefits for family law purposes. As one might imagine, there have been a series of somewhat heated comments as to the fairness or otherwise of such calculation methodologies, particularly considering that a member of a defined benefit scheme generally does not have any capacity to ameliorate or strategise to avoid Div 296 tax. Interestingly, the majority of comment has been from federal and state public servants and from the judiciary. In addition, as we've had more time to consider further implications of the Div 296 tax, some interesting issues have arisen with respect to reversionary pensions and the potential for a reversionary pensioner to come under the Div 296 taxation rules a year earlier than might otherwise have been anticipated. As an example, if after the implementation of the rules, a member died with an asset balance of, say, $2 million, the surviving spouse's total superannuation balance will be greater than $3 million and will therefore be caught in the Div 296 tax net if their balance is of an equivalent value. There is a whole extra year in which the surviving spouse is in that Div 296 tax net when the spouse would not have been there simply because of the automatic reversionary pension. This would then beg the question as to whether the reversion should continue or the pensions converted to non-reversionary pensions, with the potential trigger for a death benefit pension to be paid to the surviving spouse after the following 1 July, thus deferring the imposition of that tax. This issue has been raised by Bryce Figo from DBA Lawyers and will surely warrant a reassessment by advisors as to potential further strategies. As I referred to earlier in this vlog, The federal budget is due shortly, and our next monthly video will contain an assessment of some budget changes that have the potential to impact our advice lives. Look forward to catching up with you then.